Hey everyone, FinTech here. Today to talk about two very similar companies I've recently covered. Palantir and Snowflake. Both companies provide data products, both companies are growing at a rapid pace, and both companies are using technology and new and innovative ways to change the world. Both companies are also extremely expensive by traditional valuation metrics. In this video, I will review what each company does, how the numbers show each company is performing, and what makes the two companies fundamentally different. Lastly, I will talk about which of these two stocks I think will make a better investment and let you know if I am buying either one of them. So to understand each company better, you first need to understand how they got to where they are today. With Palantir at a valuation of $47 billion and Snowflake valued at over $73 billion, there must be some backstory to their current success. Let's start with Palantir. Palantir was founded in 2003 by 5 co-founders, perhaps most notably including Peter Thiel. Thiel got his start at PayPal, where he, along with several other future high-profile entrepreneurs, revolutionized the online payments space. Also on board with founding the company was Stephen Cohen, who at just 23 years old was credited with writing Palantir's initial prototype platform in just 8 weeks. From the beginning, Palantir was special. They got their start by focusing primarily on government contracts, including working with the CIA and other areas of national security. They later branched out into highly regulated industries such as finance and healthcare. In fact, in 2009, the Securities Investment Protection Corporation used Palantir's technologies to convict Bernie Madoff in the largest pyramid scheme of all time. Today, Palantir still has a large customer base of government organizations, but they have also made major inroads into private businesses, especially in the last year. They have 3 major products: Gotham, Foundry, and Apollo. Foundry is probably their most well-known product. Foundry is a data integration platform. There are lots of other companies in this space, including Alteryx, Talend, MuleSoft/Salesforce, but it is an important technology. Data integration allows companies to have their data flow from one application to another, such as from a customer relationship management tool into a data analytics platform. Without data integration, companies or governments could be generating the best data in the world, but they wouldn't be able to wrangle it into a useful form. While this area does have a lot of competition, it's expected to grow at a compound annual growth rate of nearly 14%, meaning that simply maintaining their existing market share guarantees growth for the company. Palantir's next product, Gotham, may not be as well known as Foundry, but it's the more important one in my view. In Palantir's words, Palantir Gotham serves as an organization's knowledge base, containing the full record of an organization's data, intelligence, and insights. Gotham is essentially big data analytics, with all kinds of tools and abilities built in to support this, including AI functionality. What makes Gotham special is its ability to extract insights from disparate sources of data. It's relatively easy to run analytics against super well-structured SQL databases that basically look like Excel spreadsheets. It's much harder to do this when you're pulling data both from databases as well as from unstructured sources like paper forms or images. Gotham creates structure from unstructured data and maps it to defined objects which are enhanced by the relationships that connect them. This has a huge variety of use cases from airline safety to cybersecurity to the military. Finally, their last product, Apollo, is more of an enabler than a full-on product. Apollo is a continuous delivery solution at the edge. So imagine you're in the military and you're deployed to a site, and you have people running analytics using Gotham. Apollo lets you deploy updates to your software even in the middle of nowhere. They say it can be used from the back of a Humvee to the hull of a submarine, and this is an obvious and necessary differentiator for defense clients. And in the future, it could even see some use cases in the commercial sector, with remote oil drilling, shipping, or aviation all being possible use cases. This seems like it might not be that big of a deal since Apollo is only really valuable when combined with Palantir's other tools, but this could be a huge differentiator for the company when it comes to competing with other data companies like Snowflake. In fact, when you put all these products together, data integration, data analytics, remote deployments, there really isn't a single competitor that hits all the same areas that Palantir does. But there's another company who seems to have equally large ambitions that is growing at an even faster rate than Palantir while delivering exceptional products to their customers. Snowflake. Snowflake was founded nearly a decade after Palantir in 2012 by 3 data architects from Oracle. They spent 2 years in what they called stealth mode, building their product while bringing on more and more venture funding. During that time, they built up over $1.4 billion in venture funding, finally launching their product to the public in 2015. They're led by a savvy businessman named Frank Slootman, who has over 25 years of experience both as an entrepreneur and an executive in the enterprise software industry. He took Snowflake public in 2020 at what was then the largest software IPO of all time, at a company valuation of over $70 billion. But why the high price for Snowflake? What do they actually do? Well, Snowflake is a data company, and data is fundamental to how modern businesses work. The more and better data you have, the better you can predict customer trends, make strategic decisions, or even just improve customer experiences. The problem is, traditional methods of handling data just aren't built for the needs of modern companies. What started as literal spreadsheets turned into databases, which eventually evolved into data warehouses, which eventually migrated to what is now being called the data cloud. The data cloud allows users to do many of the things with data that are becoming necessary to compete in our data-rich world. One of the most important attributes of the data cloud is its ability to unite siloed data. This way, organizations can discover what data they actually have and even share that data with other organizations. Sound familiar? This is a similar capability to that offered by Palantir Foundry, although Snowflake is an entirely cloud-native product versus Palantir's more secure/flexible but also harder to set up on-premise integrations. Snowflake's biggest competitors are actually the big cloud providers, Amazon Web Services, Microsoft Azure, and Google Cloud Platform. 2020 was a landmark year for companies moving their data to the cloud because with people working remotely, the need for the flexibility associated with keeping your data in the cloud became very clear. The problem is, while moving your data to the cloud lets you store basically infinite amounts of data and access that data worldwide, it doesn't mean the data is any more organized than it was before. It might even be less so. With modern businesses generating data from customer transactions, Internet of Things devices, interactive applications, all that data needs to be integrated to be useful for things like data analytics or AI. Simply making more data and storing it in the cloud does not solve the problem, which is where Snowflake really stands out. Offering an order of magnitude less complexity and upfront costs from building a custom cloud data solution, Snowflake's product handles the heavy lifting of getting data into a usable format. You can store your data with Snowflake, you can query it, you can share it across organizations. Snowflake's aim is to make data handling in general something that companies can just pay them to deal with. This lets Snowflake generate huge value for their customers, and then they just take a percentage of the money they are making their customers for themselves. It's a win-win, which is probably why Snowflake is the fastest growing large software company that I have ever seen, growing revenue 110% year over year in their last quarter. Of course, with that growth comes a sky-high valuation of $73 billion for a company that only has $600 million in revenue last fiscal year. So that's some background on the company's stories, but now let's take a look at the numbers. Now in these numbers, I'm mainly going to be looking at revenue, gross margins, and growth. Profitability is not a huge issue for me, as I hope that these companies are investing everything they have into building new products and growing in size. So now let's compare Palantir and Snowflake's earnings from their most recent quarter. Right now, Palantir has a market cap of $47 billion versus Snowflake's larger market cap of $73 billion. Last quarter, Palantir reported quarterly earnings of $341 million, up 49% year over year. At the same time, their US government revenue grew 83%, while their US commercial revenue grew 72%, driven by both existing customers and new customers. Palantir's total number of customers hit 149, combined between both the governmental and the commercial segments. They also had $151 million in adjusted free cash flow, and their adjusted operating margin was 34%. The thing is, they also spent $194 million on stock-based compensation this quarter, which if you add that into their adjusted free cash flow, takes their actual free cash flow negative. Management is also forecasting to see growth greater than 30% for the foreseeable future. Now, 30% would be a huge disappointment from their current growth, so that's obviously an underestimate from what I think is probably going to be closer to around a 45% growth rate this year. Looking at Snowflake, their last quarter revenue was $214 million, up 110% year over year. So Palantir obviously has more revenue, but Snowflake is growing way faster. Snowflake had a dollar-based net expansion rate of 168% this quarter, meaning that for every dollar one of their customers spent last year, they can expect them to spend $1.68 next year. This is a really good sign that customers like Snowflake's products because once they spend some money on it, they're more likely to spend more on it in the future. Snowflake is also confident that they'll keep their dollar-based net expansion rate above 160% for this fiscal year. That seems pretty reasonable, as the lowest it's dipped in the last 5 quarters was 158%. And that was right at the start of a little global crisis that had most companies panicking. Snowflake now has 104 customers who pay over $1 million in product revenue, but they also have many smaller customers. In fact, in Q1, they added 393 net new customers, some of which will likely grow into $1 million plus customers as they expand their usage of the platform. Their product gross margin was 72%, which is up 600 basis points from last year, and they also have $5.1 billion in cash on the sidelines, partly for their Snowflake Ventures business. This is a branch of Snowflake that invests in up-and-coming data companies and technologies. Snowflake forecasts that for the second quarter of fiscal year 2022, they expect product revenues to be between $235 and $240 million, representing a year-over-year growth rate between 88% and 92%. For the full fiscal year of 2022, they expect their product revenues to be between $1.02 billion and $1.035 billion, which would represent a year-over-year growth rate between 84% and 87%. Now, I personally think that's likely a conservative estimate, and I would not be surprised at all if they hit 100% growth for the full fiscal year of 2022. So to summarize the comparison between Palantir and Snowflake, Snowflake is growing a little more than twice as fast as Palantir, but it's also valued nearly twice as high. Additionally, Palantir has higher earnings than Snowflake right now, meaning that if growth slows for either company, Snowflake's stock price would likely take the bigger hit. Now, Snowflake does have a ridiculously high dollar-based net expansion rate of 168%, and while Palantir is very secretive about their customers, it's clear from their government work that they are also doing a good job of upselling their product usage. And on top of those really impressive numbers from both companies, both stocks also have a very compelling story. So then comes the valuation question. I read an article on Seeking Alpha by a writer named Bert Hochfeld who did a good job of summarizing the key point. The issue for investors is not really the likely success of these companies or the fact that they are down a great deal from recent post-IPO valuations. The issue is their current valuation and future growth. Look, these companies are going to change the world. There's no question in my mind. The only question is, can these companies continue to grow at their current rates long enough to make up for their extremely high current valuations? Now, because Snowflake is growing so much faster and has a higher valuation, based solely on the numbers, I see this as the more risky investment, because any slowdown whatsoever will tank the price. At the same time, if Snowflake can grow just one more year than Palantir at its current rate, it could easily become double Palantir's size. But Palantir is also growing well and may grow into its valuation. But I do have concerns over how much money they are paying out in stock-based compensation. Right now, their growth is fueled by expensive teams of engineers setting up data integrations for companies, but that process needs to become automated for the company to one day become profitable. Is that possible? Yes. Has it been proven? No. So purely from a numbers perspective, while Snowflake seems more risky, I think that hidden risk puts Palantir over the edge and makes it, for me, a slightly less attractive investment. Palantir could absolutely still do well. But before I invest, I really want to see them start to grow their non-adjusted free cash flow first. I currently hold a 7% position in Snowflake. It has declined around 10% from where I first bought it, but I am comfortable with that amount I currently have invested in it. It's not my highest conviction position, but I think its potential to do well is worth getting in early in what I think will be a world-changing stock. Your takeaway might be totally different, and if you think you have a good argument for one versus the other, I'd love to hear it in the comments. I read and try to respond to pretty much all of them. If you are interested in stocks or just want to get started, one of the easiest platforms you can use is WeBull. When you sign up today and deposit $100 or more, they'll give you 2 free stocks valued all the way up to $1,600. Or if you don't feel like depositing that much money, you can still get 1 free stock just for signing up. Don't forget to like and subscribe, and I'll see you next time.